India Decides, the FII View with me, Tanveer Gill. This is the show that puts a spotlight on India and gets you what global fund managers are making of the India story, given the global backdrop. My guest today on the show is Ewen Watt, who's Chief Investment Strategist at the BlackRock Investment Institute. Mr. Watt joins me from London. Mr. Watt, thanks very much for taking out the time to speak with us today. Let me begin by asking you specifically on your India view. You have stated in your 2014 Outlook report that it is an important election for India, as a pro-reform government can put India on track for a growth breakout, quote unquote. How are you looking at the growth cycle in India on appointment of a new government? For so far, we are still trying to defend the 5% mark on growth.
I think the great Indian growth cycle is really going to depend to an extent on what the election outcome is. And that's the difference between an overall majority, a strong coalition, or a weak coalition. In the case of an overall majority, which we think can only be won by the NDA, the BJP coalition, then I think you'll see greater certainty of planning. You'll see a number of reforms to speed up the economic process, and just generally a more confident business climate. In the event of a moderate coalition, let's say 230 or so seats, I think you'll get still some of that, but there'll be enough horse trading between the parties in the coalition to mean that business certainty is a bit lower. And of course, if you get a weak coalition with a whole series of regional parties with individual state interests at play, then that simply won't happen.
Well, what would be the key driver, Mr. Watt, for growth in India? Because it's largely being touted as a domestic consumption story, but right now it seems like there's more focus on growth coming in from the export side. So, what will be the key driver for growth that you'll be watching out for going forward?
India really is a domestically orientated story. Sure, exports have grown over the last few years, but the thing that's really held back Indian growth over the last couple of years has been slow, very slow investment and relatively subdued domestic consumption. The net exports have been impacted, or net trade's been impacted by energy imports, but really to turn the dial, the investment cycle in India needs to pick up again and domestic consumption needs to rally.
Well, a large part of what happens with Indian exports is dependent on the currency, the rupee. What is your view here? Because we've seen a sharp appreciation in the rupee from the start of the year till now.
The rupee has strengthened considerably over the last 6 months. In the currency crisis, as it almost was, let's say, back in September of last year, as you know, it really nearly got to about 69 to the dollar, and currently it's a touch under 60. Now, fair value calculations for currencies are always tricky things, but you have to say that at the current price, the rupee doesn't look particularly undervalued.
Well, let me just talk about the Indian market then. That's the other key point. The market has gained more than 8%, in fact, close to 10% in dollar terms, given the currency gain, if you account for that. It is the best performing market across world indices. Only I think New Zealand and Jakarta have done better than us this year so far. How do you rationalize this move for the Indian market?
Well, the classic model for investing in emerging markets is that when the currency is weak, as it was last year, the stock market becomes attractive, because if you have a floating currency, what happens then is that policymakers raise domestic interest rates to protect the policy. Raising domestic interest rates depresses the price of domestic assets. So you now have an asset price that's down in local currency terms and down in dollar terms as well. You have now two chances of making money. One, because the domestic asset has fallen in price, and two, because provided that real interest rates have been raised enough, the currency will rally. So you make money out of the currency and you make money out of the domestic assets recovering because they've got to an oversold position. That's what happened with India, that's what's happened with Indonesia, that's what's happening with Brazil right now. It's the classic model. You buy emerging markets when their currencies are very cheap, because, as I say, you get two chances of making money.
Also, Mr. Watt, on the improvement in twin deficits and improving macros, the criticism the government has received is that the numbers have improved, but the intrinsic problem still remains. Do you share that view, that compression in current account deficit, fiscal deficit, is difficult to sustain going forward?
The improvement in the current account is substantially down to two factors. One is the effective bar on gold imports, and the second has been reforming some of the fuel price, diesel prices and so on, which has reduced consumption and therefore reduced imports. On the fiscal side, I think that just takes a whole lot longer. India as a country, as we know, has got very substantial longer-term social obligations to meet. The big income disparity, rich against poor, is an important issue here. I think that the current account deficit is probably, what is it now, 2%? It's probably about as low as one would expect it to go. And of course, if the economy does pick up, and it is driven by domestic consumption and by investment, then the arithmetic is that the current account deficit will deteriorate a little bit again. But I don't see that as a big problem, because the credibility of the Reserve Bank of India, since Raghu came in as Governor Rajan's come in, has improved very considerably. And I think that investors are a lot more comfortable with the path of policy in relation to at least the monetary side of the equation now.
Right. On politics, what possible scenarios are you working with, given exit poll analysis so far? Is the focus on an NDA coalition or a Modi-led BJP government? Well,
those are two very different outcomes. And we have to remember that the polling is quite inaccurate, not in the sense the polls aren't taken properly, but for example, there's 97 million new voters, first-time voters, in this election, and trying to get a sense of the pattern of voting from those nearly 100 million new people is tricky, just as it is to get accurate polling in the rural parts of the country. We've seen this before. In the last two elections, the polls were not particularly good guides to the actual outcome. As I said, I think that a majority, which I think is unlikely, an NDA majority is probably unlikely, given some of the regional and religious issues in play. That would be a very positive impact for the country and for the stock market, and that's absolutely not priced in. I think what's pretty priced in now is a moderate coalition, let's say 230 to 250 seats for the NDA-led coalition, which I think is pretty much priced into the market now. The market's risen, the currency's risen over the last few months. What's not priced in is the, I think, relatively unlikely outcome of the BJP being unable to form a coalition, or having to, such a weak vote, let's say less than 200 seats, that they have to do so many deals with regional parties that government coherence doesn't come about.
Also, Mr. Watt, do you think that India's credit profile has improved in the last 18 months, since the risk of a credit downgrade on the region, given all the policy measures that have been taken by the finance minister and the new governor?
I think India's credit profile has improved, but almost entirely because of the credibility gain by the Reserve Bank of India. I'm not confident yet on the fiscal side of the equation, as I explained previously. And of course, to an extent, that's intertwined with the election outcome. But certainly the credit dynamics are not deteriorating. And there is, as I say, greater confidence, understandably, with an absolutely world-class central bank governor in place now.
Mr. Watt, then if you step back, how much of the India story is domestic policy-led, according to you, and how much of it is relative to other emerging markets, given the fact that there is a lot of credit risk, geopolitical risk in the region?
Look, India is a domestically orientated economy, which, and I think one of the trends in emerging market investing that we're seeing is that there's a growing dispersion. I mean, one used to just talk about emerging markets, the single asset class, and then irritating acronyms like BRICS come along, and you try to believe that Brazil and Russia and India and China are all the same, which they're not. And I think a more grown-up attitude is starting to develop here, where people do distinguish between economies and stock markets and currencies to a greater extent. More dispersion, as we say. Now, the Indian story is really about the policy change around rather than the economic recovery, and it's really about the election. And those are two very specific India focused issues. At global level, judging by exchange traded fund flows, money's still going out of emerging markets as a whole. But then, as you say, we've had some winners and we've had some clear losers over the last several months, which suggests that the dispersion theme is very much in play. And interestingly, whereas 6 to 9 months ago, the strong performers were the countries with current account surpluses, strong domestic financial systems, over the last few months, because real interest rates have risen in South Africa, they've risen in Brazil, they've risen in India, they've risen in Indonesia. They haven't, for similar reasons, risen in Russia because of the geopolitical issues there. But with those real interest rates rising, we've seen the rupiah, the Indonesian rupiah strengthen, the rupee, as I've said, strengthen. The Brazilian real is strengthening now. The South African rand, having been very weak, has bounced back away. And the stock markets are recovering on the back of that.
Right, let's talk about world markets then, especially the US markets. Now, after closing up 30% in 2013, the US indices have largely been flat year to date. So far into 2014, that is the first quarter that we've seen till now, despite being at record highs. What do you make of the optimism on 2014 being another strong year for US equities? Does that still hold?
Well, US equities this year have been a story until recently, very recently, of being very much led by a few narrow growth stocks, growth sectors, wireless internet, some of the biotechnology, IPOs have done extremely well. And just in the last couple of weeks, there seems to be a bit of a rotation away from growth towards value. So we've seen financial stocks starting to perform reasonably well. Also, there's been, obviously, as people know, an appalling winter, even by North American standards, and that's clearly had an impact on the growth of final demand. And we would expect to see demand starting to strengthen as we move into the spring and the snow thaws. But this rotation point away from, the growth things that have been leading the market into more value investing is, of course, also tied up with the other big factor in America, which is the Federal Reserve's tapering program. Now, this is where the Federal Reserve every month reduce the volume of bonds that they buy. And it seems to us that what the Federal Reserve have decided that they're going to go on with that program for a while now because they're concerned about financial speculation that comes about from having too loose a monetary policy. And it's the recognition that that is changing the leadership of American equities. When you look at the S&P 500 as a whole, what you see is that earnings per share are growing, but very material extent because of share buybacks, which are being funded by easy financing. And therefore, the American market becomes a little bit vulnerable if interest rate expectations shift upwards, if there's too strong an economy. Right now, it's a sort of Goldilocks position, and we think that at aggregate level, the S&P can move up a little bit further, but the leadership is changing towards more value sectors such as financials and domestic consumption stocks.
With most views on the street giving a thumbs up to the US markets, do you think that it's time to be a bit contrarian and a bit wary of the over-enthusiasm, so to speak, there is for the US markets?
Well, we've been very much preferred non-US assets in the equity space for the last 6 to 9 months. Partly because the valuations overall for American equities have risen to a certain extent, partly because it's also tied in with the share buyback theme that I've talked about, which isn't quite the same as organic top-line growth. And the focus has been very much on European assets, which have done pretty well, and also avoiding emerging markets as a whole, although there are those that have done well, going back to the dispersion theme. And I think there's a little bit of a change going on right now where European assets have done extremely well, and maybe the focus is now going to switch not to America because of the valuation points that I mentioned, but partly to emerging markets if there's a stimulus announced relatively soon in China. There is no doubt the Chinese economy slowed down quite a lot in the last 3 months. And secondly, also to Japan, where the pace of structural reform, of really long-term reform, is going to start accelerating again in the next 3 months with a series of policy developments which will get announced.
Right, Mr. Watt, how should one interpret the data in the US? There's growth, but not as much as expected. Tapering will be followed by tightening, putting pressure on liquidity. And investment in domestic consumption have not picked up again as was expected at the start of this year, backed, of course, by a shrinking workforce and falling unemployment. Is this a conducive backdrop for a bull market, you think?
Well, the US, first of all, is going to be one of the stronger growing major economies, but that's not going to be saying a lot because of the factors of population growth, but more debt overhang and lack of real income growth that you're mentioning. So if you like, it's the best house on a bad street. I think that the real economic stories lie elsewhere in the world in terms of change of perception of growth. The other thing I'd say about the US is that the first quarter of the year, you know, the weather has been truly appalling over much of the country. It's been the 5th or 6th worst winter, for example, as measured by snowfall in Central Park that New York has experienced in history. And it's kind of difficult to get out there and consume if the snow is falling really heavily day after day after day. And I think there will be a modest pickup in activity, therefore, in America in the next couple of quarters because of pent-up demand. Let's not forget, real income growth is slow, but it is positive. Declines in commodity prices are increasing final consumer power. Corporations are slow to invest, and indeed, one of the great puzzles of the time is why companies don't want to spend more money on plant and equipment. And so I think we're looking at an economy which will probably grow 2.5% in real terms this year, and with a bias towards the middle and end of the year rather than the start.
What's your view on the US dollar, given the underlying macros in the US, you know, with an inflated balance sheet and a deficit situation prevailing? What does the greenback do from here?
Well, the US dollar is like any currency, is driven by supply and demand. And that's the easiest way to think about a currency. It's a commodity. Any currency is a commodity. And, you know, the dollar should be stronger against other currencies, and it has strengthened against a number of the emerging market currencies and now weakened a little bit because of the tapering process that I referred to earlier. In other words, the Fed is buying less and less new dollars into the economy, and so the supply of dollars is growing relatively more slowly. As that happens, if the world economy picks up as the year goes on, demand for dollars outside of the US increases because we use the dollar to buy oil, we use it for shipping, we use it for aviation. It's the world's reserve currency. In an environment where the supply of US dollars is growing proportionally more slowly and the demand is growing a little bit faster, you know, you would expect the dollar to rise. But the question is against what? Most likely against the yen, which is one reason for being positive about the Japanese stock market, because that tends to go up as the yen goes down. And we know that the Bank of Japan is going to continue to print money, in other words, to supply currency at a greater rate than there is demand for it for a while to come. The euro is a bit harder because Europe runs a current account surplus, so it doesn't need to borrow any money from abroad. The European Central Bank is running quite a tight policy in terms of not growing its balance sheet very much at the moment. And that explains one reason why the euro has been holding up against the dollar. On the emerging market currencies, you know, I think it's a question of which currency and which time horizon. But, you know, overall, a modestly strengthening dollar over the next 1, 2, 3 years is a tightening of global monetary conditions because the dollar is the most liquid currency in the world. And if it becomes more expensive for other people, so financial conditions for those other people tighten a bit.
Right, Mr. Watt, I also wanted your view on the technology sector in the US, which is looking a bit vulnerable. Many are comparing it to the 2000-2001 IT bubble, you know, given the enthusiasm and the excitement, and also the outperformance that the NASDAQ has shown to the S&P 500 as well as the Dow Jones. Do you think it is different this time, or you also share the same concern that perhaps we are stepping into a bubble of sorts?
Well, there is no such thing as the tech sector in the US. It's a series of subsections. I mean, there's no connection, if you like, between the share price of Google and the share price of Microsoft. And in that Google's share price has risen, enormously, and Microsoft's has flatlined for a number of years now. Yet, of course, they're both in the same industry. It rather depends on the sector they're addressing and the demand for the product and so on. I think there are some great long-term technology-based investments in the United States. It's still the world capital for technology investment and innovation, and it will remain so. But that said, there's certainly been a craze about social media. There's certainly been a craze about wireless internet. There's certainly been a craze about cloud-based systems. And just as in 2000, that craze has probably taken prices, beyond the level that seem reasonable. Now, those prices can remain high for a very long time while the earnings catch up. And the trick for successful investing is not to label it just tech, but it's to work out which are the companies with the sustainable business model that's going to allow them, as they were, to grow into the valuation. And so there's an enormous dispersion. But I do think that there's a bit too much froth, perhaps right now, in some of the smallest mid-cap stocks that have led the technology-based investing over the last 6 months.
And finally, Mr. Watt, how do you see China as a story for the rest of the world? Do you see China as a risk or an opportunity at this point?
Oh, China's always both. It's always a risk and an opportunity and a puzzle and a goodness knows what else. I think that what the Chinese government is doing is absolutely correct in terms of addressing the need to rebalance the economy away from investment and towards consumption. But it's a painful process, and it's a drawn-out process. One can be absolutely confident that the Chinese financial system is not likely to collapse. Why? Because with so much of the deposit base owned by domestic citizens, the Chinese government are not going to encourage instability, social instability, by there appearing to be not enough money in the banks to pay everybody. So you can be pretty sure when you read about little bank runs that the local government and the PBOC will be there with large trucks of banknotes to reassure everybody that their money is safe. But that's not quite the same thing as is it healthy enough to grow without stimulus from the centre. And I think that's going to be a real focus over the next few months. Too much stimulus and people will lose credibility that the government's trying to reform. Too little and they'll go on being concerned about the financial system.
Fair enough. Mr. Watt, thanks very much for taking out the time and speaking with us today. We really appreciate your views and your insights on India as well as emerging markets at large. With that, of course, we come to the end of this edition of India Decides the FII View. We'll catch you with another special guest next week. Till then, take care.